Investing is crucial to building wealth and securing one's financial future. However, not all investment decisions are successful. In fact, throughout history, numerous examples of investments have turned out to be disastrous. These catastrophic choices have left investors financially devastated and serve as cautionary tales for those looking to navigate the treacherous waters of the investment world. This video explores some of the worst investments ever made, highlighting the valuable lessons they provide. In the annals of financial history, few episodes capture the essence of speculative excess as vividly as Tulip Mania. This infamous event unfolded in the Netherlands during the 17th century, when tulip bulbs became the object of frenzied speculation, ultimately leading to a catastrophic bubble burst. Tulip Mania is a cautionary tale, highlighting the dangers of irrational exuberance and the consequences of placing blind faith in an asset's future value. Let's delve into this ill-fated investment frenzy and its enduring lessons. The origins of Tulip Mania can be traced back to the arrival of tulips in the Netherlands from the Ottoman Empire in the late 16th century. These exotic flowers fascinated the Dutch, who quickly developed a fervent passion for them. Tulips were seen as status symbols, coveted for their vibrant colors and unique patterns. The market demand for tulip bulbs grew steadily, with prices gradually escalating. By the early 17th century, a speculative frenzy had gripped the Netherlands. People from all walks of life, from aristocrats to merchants, began investing in tulip bulbs with the hope of making enormous profits. The allure of tulip bulb trading lay in the fact that investors could purchase bulbs at one point in the year and sell them later at a significantly higher price during the flowering season. The speculative fervor surrounding tulips reached its zenith in the 1630s. Prices soared to astronomical levels, with some rare tulip bulbs commanding prices that surpassed the value of luxurious houses. The market became increasingly detached from reality as more and more people rushed to invest, hoping to secure immense wealth quickly. In 1637, the bubble finally burst. A sudden wave of panic swept through the tulip bulb market, causing prices to plummet rapidly. As traders scrambled to sell their bulbs, the market became flooded with supply, leading to a complete loss of value. Tulip Mania serves as a stark reminder of the perils of speculative bubbles and the dangers of irrational investing. It highlights the susceptibility of markets to collective hysteria and the human tendency to extrapolate past trends indefinitely. Once seen as a symbol of prosperity and wealth, the tulip bulb became a symbol of financial folly. Tulip Mania also underscored the importance of fundamental analysis and prudent investing. Hey, everyone! Before we continue with the video, I have an exciting announcement for you. Have you ever wanted to gain valuable investing insights and financial advice from renowned financial experts? Well, now you can with the Best Stocks newsletter. By subscribing to the Best Stocks newsletter, you'll have the opportunity to discover innovative investment ideas that you may have never considered before. Our team of experts carefully curates stock recommendations by aggregating signals from the highest-paying programs on the web. And guess what? We even give away free stocks. We recently gave our newsletter subscribers 5 Apple stocks valued at $859, and we have more exciting giveaways coming up soon. The dot-com bubble of the 1990s stands as one of the most notorious episodes in financial history, characterized by an unprecedented surge in investments in internet-based companies. The era witnessed an explosion of speculative fervor as investors poured their money into dot-com startups with the hope of reaping astronomical returns. However, the bubble eventually burst, leaving behind a trail of shattered dreams and valuable lessons. The 1990s marked the dawn of the internet era, with the World Wide Web becoming accessible to the masses. The potential of this new technology to transform industries and revolutionize communication sparked immense excitement. Investors eagerly sought to capitalize on the emerging opportunities, fueling a wave of investments in companies associated with the internet, commonly referred to as dot-coms. Startups with little to no profitability or a viable business model experienced meteoric stock price rises. Investors clamored to participate, often neglecting fundamental analysis and blindly chasing stock prices higher. A significant disconnect between stock prices and the actual value of the companies characterized the dot-com bubble. Investors ignored traditional valuation metrics such as earnings and focused instead on factors like user growth and market potential. This exuberance led to unrealistic valuations, with companies trading at price-to-earnings ratios that were astronomical by historical standards. In early 2000, the bubble burst, triggering a massive sell-off in tech stocks. Many dot-com companies with unsustainable business models and weak financials were exposed. Stock prices plummeted, wiping out billions of dollars in investor wealth. Several high-profile companies that were once market darlings faced bankruptcy and liquidation. The dot-com bubble is a cautionary tale for investors and entrepreneurs, highlighting the dangers of unchecked optimism and inflated expectations. Many dot-com companies focused solely on growth and market share without a clear path to profitability. The bursting of the bubble highlighted the necessity of generating profits and delivering value to investors in the long run. The real estate bubble of 2008 stands as a stark reminder of the devastating consequences that can arise from unchecked speculation and excessive risk-taking in the housing market. This period witnessed a surge in housing prices, fueled by loose lending practices, financial innovation, and investor optimism. However, the bubble eventually burst, leading to a global financial crisis and a profound economic impact. Let's delve into the story of the real estate bubble of 2008 and the important lessons it offers. In the early 2000s, a perfect storm of factors led to the rapid escalation of housing prices. Fueled by financial deregulation and the proliferation of subprime mortgages, loose lending standards allowed more people to access home loans. Low interest rates and easy credit availability further fueled demand for housing. The increased demand, combined with limited housing supply, created a fertile ground for speculative investment. The financial industry played a significant role in the real estate bubble by creating and marketing complex financial instruments. Mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, allowed banks to package and sell mortgage loans as investments. These instruments, often backed by subprime mortgages, were given high ratings by credit rating agencies, despite their inherent risks. This enabled the proliferation of risky loans and created an illusion of stability. In 2007, the bubble began to deflate as housing prices reached unsustainable levels. As interest rates rose and adjustable rate mortgages reset, homeowners faced difficulty making their mortgage payments. The subprime mortgage market collapsed, leading to a wave of foreclosures. The subsequent glut of distressed properties flooded the housing market, causing prices to plummet. The housing market's collapse had far-reaching consequences, triggering a global financial crisis. The real estate bubble of 2008 serves as a stark reminder of the dangers of excessive leverage, lax lending practices, and financial innovation without proper risk assessment. The episode underscored the significance of effective regulation and oversight. Furthermore, the collapse of the real estate bubble highlighted the interconnectivity of financial markets and the potential for contagion. It emphasized the need for a holistic view of the financial system and the recognition that risks in one sector can have far-reaching consequences. Blockbuster Video, once an industry giant and a symbol of home entertainment, found itself on the wrong side of history during the 2000s. The company's failure to adapt to changing consumer preferences and embrace emerging technologies led to its demise. Blockbuster's story is a cautionary tale for businesses that underestimate the power of innovation and fail to evolve with the times. Let's explore the downfall of Blockbuster Video and the lessons it offers. Founded in 1985, Blockbuster quickly became dominant in the video rental industry. The company capitalized on the demand for home movie rentals and built an extensive network of physical stores. At its peak, Blockbuster had thousands of locations worldwide, offering its customers a wide selection of movies and video games. The 2000s witnessed a seismic shift in the way people consumed media. The rise of the internet and the advent of digital streaming services revolutionized the entertainment landscape. Companies like Netflix and Redbox emerged, offering convenient alternatives to traditional video rental stores. These platforms embraced the digital revolution, allowing customers to stream or rent movies without leaving their homes. In 2000, Reed Hastings, the founder of Netflix, proposed a partnership with Blockbuster, offering to sell his company to them for $50 million. However, Blockbuster declined the offer, underestimating the potential of streaming and the changing preferences of consumers. As digital streaming gained popularity, Blockbuster struggled to compete. The company attempted to launch its online rental service and eliminate late fees, but these efforts proved too little, too late. Blockbuster's heavy reliance on its physical store model and resistance to embracing digital innovation ultimately led to its downfall. Blockbuster's failure to adapt holds valuable lessons for businesses in the digital age. It underscores the importance of recognizing emerging trends and being open to innovation. While the company was focused on its traditional business model, it needed to prioritize convenience and ease of use for its customers. In contrast, digital streaming services like Netflix capitalized on these factors, providing customers with a seamless and accessible experience. Cryptocurrencies, with their promise of decentralized and secure transactions, have recently gained significant popularity. However, the rise of cryptocurrencies has also been accompanied by increased scams and fraudulent schemes targeting unsuspecting investors. These scams exploit the relative anonymity and lack of regulation in the cryptocurrency space, resulting in financial losses and tarnishing the reputation of this emerging asset class. Investors must know the risks and take necessary precautions to protect themselves. Let's delve into the world of cryptocurrency scams and frauds and explore ways to safeguard investments. Cryptocurrency scams come in various forms, ranging from fake initial coin offerings, ICOs, and Ponzi schemes to phishing attacks and fraudulent exchanges. Scammers often employ sophisticated techniques to deceive investors, promising high returns, insider tips, or exclusive investment opportunities. They prey on the FOMO, fear of missing out, mentality and exploit the cryptocurrency market's lack of investor knowledge and regulatory oversight. Recognizing the warning signs of cryptocurrency scams is vital for investors to protect themselves. Some common red flags include unrealistic promises. Scammers often promise unrealistic returns or guarantees of profit, luring investors into their schemes with the allure of quick riches. Lack of regulation and transparency. Beware of investments or platforms operating in unregulated or obscure jurisdictions. Lack of transparency regarding the team, technology, or audited financials is also a warning sign. Pressure to act quickly. Scammers create a sense of urgency, pressuring investors to act immediately without conducting proper due diligence. Unsolicited communications. Be cautious of unsolicited emails, social media messages, or phone calls promoting investment opportunities. Legitimate projects rarely engage in such practices. To safeguard against cryptocurrency scams and frauds, investors should take several precautions. Research extensively. Thoroughly research any investment opportunity or project before committing funds. Investigate the team members, technology, white paper, and partnerships. Verify the project's legitimacy by checking if it is registered with relevant regulatory authorities. Look for reviews, independent analysis, and community discussions to gain insights. Use secure wallets and exchanges. Choose reputable cryptocurrency wallets and exchanges with robust security measures. Enable two-factor authentication, 2FA, and keep private keys secure. Use reputable and encrypted websites when making transactions or providing sensitive data. Stay informed about the latest scams and fraud tactics prevalent in the cryptocurrency space. Follow trusted news sources and engage with knowledgeable communities to enhance your understanding. The worst investments in history remind us that investing comes with inherent risks and pitfalls. While past failures do not guarantee future outcomes, they provide valuable lessons for investors. Thorough due diligence, diversification, avoiding speculative manias, staying informed, and adapting to changing market dynamics are essential for making sound investment decisions. Learning from past mistakes can help investors navigate the complexities of the financial world and strive for long-term success.